All right, all right. Hope you are doing well. Praise God. We're just kind of reviewing the activities of the week, really looking at what we see taking place, sharing some of our team's best thoughts with you, and just, food for thought so that you can have thoughts for consideration. So again, we saw last week that the Fed, cut interest rates by 25 basis points, bringing it down to the Fed funds rates of 3.5 to 3.75. So that's great. That affects variable rate loans. Again, a lot of people, shouting and jumping up and down. All right, rates have been cut. It is good, but again, like you look at the 10-year Treasury in the last two cuts in the last 2 months, the Treasury is still tracking around 4.1, 4.18 on the 10-year Treasury. So again, you can see that even though they've cut 50 basis points on the Fed funds rate, that is not translated into the bond market. The bond market doesn't follow the Fed. The bond market is driven by overall market conditions. And so, because of where we are currently in the economy, inflation seems to be, staying where it's at. And then, the unemployment is about where it's at right now. It hasn't moved dramatically one way or the other in the most recent reporting. It's not looking completely dire. So the bond market is not really, in favorable response. It's staying where it's at, and so what does that mean? It's what we've been saying for a couple of years now, that interest rates are going to be higher for longer. The Fed, even in their forecast, saying, they're kind of penciling for one cut next year to bring it down to like 3.25. That being said, again, the bond market is what's driving the fixed rate loans for Fannie Mae and Freddie Mac. It's also the driver predominantly for the single family home loans as well. So, we are in a place where interest rates are in a more favorable condition, and it's likely that they're going to move down a bit next year. When you step back and take a look at a couple other factors coming into commercial real estate and the focus for 2026, you see a lot of the new construction that had been coming online that was built in that, 22 to 25 cycle getting completed and coming online. The absorption is finally starting to move through with some, 353,000 units, I believe, still being absorbed. And again, it depends and varies market by market, but we've seen that in various markets, whether it's down in Sarasota or in Atlanta or other areas where there is new projects that have come online. That has caused a bit more competition in the marketplace, because a lot of times they're, offering 2 or 3 month move-in specials for free rent, which reduces their rent in a more competitive way. So again, but in a good note, that's being absorbed, and we see that the market is poised to begin to move forward. Now, in terms of deal volume and transaction volume, this last quarter, it's about 13% higher than last year, and it actually is on par with the similar deal volume that was being transacted 2015 to 2019 pre-pandemic. So deals are starting to move forward. One of the things, though, that I would say that, you're going to hear more about it from me and potentially from others, though, is the distress that's in the marketplace. There has been distress in the commercial multifamily space and commercial space over the last several years for a number of reasons. You have elevated interest rates, elevated insurance, elevated costs because of the high cost of inflation and the impact that's had on goods and services, and the fact that you have that high interest rate where properties were bought and the interest rate continued to go up in many cases by almost 50% from where it may have started in 22. And that's put significant distress on the property. And there also are some areas, as we've outlined many times previously, in and around Atlanta. There's multiple counties that stayed back evictions all the way into 2024, that they had a scheme, if you will, in place to delay the evictions. Even to talking with another operator there in Dallas, there's a couple of municipalities in the submarkets there that have got in place where if the tenant requests hearing, it delays the eviction anywhere from 5 to 7 months. So again, these are all policies that have been instituted in a liberal way that have further hurt and distressed property. So that being said, we're coming into a space where there's more distressed opportunity that's going to be coming into the market. We've already seen some of that being surfaced right now, where properties that would normally sell for 95 to 100 a door may be able to be purchased at the 60 or 65 range. So that's a 35 to 40% discount off pricing. And so that represents a tremendous opportunity. So again, you've got a number of things that are coming together that are going to shape up to make 2026, I would say, an incredible opportunity for all of us, where you've got interest rates that are moderating, you've got demand that's coming back into play, you've got distress that's coming into the marketplace that's going to present opportunity, and you've got more capital aligning to come into these markets as well. So it is shaping up. And I know, look, some folks, again, I go to like a Warren Buffett scenario. It's like when there's blood in the streets, that's the time to buy. And again, some of these distressed type properties have been an area of pain, no doubt, for people over the last, call it 3 to 4 years. But it's in that area of pain that's going to present significant opportunity. So, all right, well, friends, you have a blessed and victorious week, for this is the week God has ordained for you.